Hey everyone, welcome back to Corporate Decoder. Today I.F.B.D just filed their amended 2025 annual report, and I am seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing looks like a big correction after some accounting errors were found, and unfortunately, it gives us a very clear picture of the company's tough financial spot. So this isn't a brand new report, it is actually an update to their 2025 annual report. They found some accounting mistakes in the original report for the year ending the 31st of December 2025, and they needed to fix them. Think of it like a corrected version of a statement, but it highlights that things weren't quite right the first time. Let's dive into what is really going on with the business. They are really upfront about how much they rely on just a few big customers. For example, in 2025, 2 customers made up over 80% of their total income. And it is not just the income, it is also the money they are still owed. As of the 31st of December 2025, 2 customers accounted for over 86% of all the money that was still outstanding. This is a huge concentration risk. If even one of these big customers decides to stop doing business with them, it could really hurt the company's finances. It is a bit like having all your eggs in 1 or 2 baskets. Now let's look at the actual numbers, the consolidated balance sheets. As of the 31st of December 2025, their total assets were about $23 million. That sounds okay, but then we look at their liabilities, which are the debts and money they owe, and that number is almost $5 million. So what does this all mean? Let's look at their income statement. For the year ending the 31st of December 2025, their total revenues were about $8.7 million. That sounds decent, but their total operating expenses were a massive $55.4 million. That's a huge difference, right? This led to a big loss from operations of over $52 million. A significant chunk of this loss, over $51 million, comes from something called impairment of goodwill. Think of goodwill like the extra value of a company that isn't tied to physical assets like its brand name or customer relationships. When a company's value drops significantly, they have to write down that goodwill, which results in a big expense on their books. They recorded over $51 million in goodwill impairment in 2025. This is a direct reflection of how much the business value has shrunk. Looking back in 2024, their total revenues were around $1.4 million, and their operating expenses were much lower, around $2.3 million, leading to a loss from operations of about $1.7 million. That looks bad, but it is much better than the over $52 million loss in 2025. The contrast is really stark, and when we look at their cash flow for the year ending the 31st of December 2025, they used over $500,000 more cash than they brought in from operating activities. This is a negative cash flow from operations, meaning the core business is burning through cash. This is especially concerning because they also spent money on investing activities like acquiring PureTech and had financing activities that brought in money. But the core operations themselves are costing more than they earn in cash right now. Now, the company did try to raise money in 2025. They brought in about $645,000 through short-term loans. In 2024, they raised around $5.7 million from issuing stock. And in 2023, they raised a whopping $52 million from issuing stock and convertible bonds. But even with all that money coming in from financing, the operating losses are still a major problem. The ultimate result for shareholders is a significant net loss. For 2025, the net loss attributable to Infobird Co. Ltd. was over $52 million. In 2024, it was about $2.1 million. And in 2023, it was about $2.5 million. The huge jump in net loss in 2025 is largely due to that massive goodwill impairment and the operating losses. Looking at the stock price, it has been struggling, trading well below its highs and currently hovering around $1.11, with a 52-week range of $0.66 to $2.17. The market is clearly not valuing the company highly right now. Even major institutions like Susquehanna hold a very small percentage of the company's stock, about 0.3%. This suggests limited institutional interest and confidence. The company also talks a lot about business risks, and one glaring issue is their reliance on a few major customers. This customer concentration is a big deal. Plus, they mention the intense competition in their markets and how newer companies with fresh ideas could easily outrun them. The risks related to doing business in China are also heavily emphasized. Things like changing government policies, trade disputes, and uncertainties in China's legal system are constant concerns. They even talk about potential difficulties in investigations if US regulators need to look into things in China. And then there is the whole issue with audits. The Holding Foreign Companies Accountable Act, or the HFCAA, means that if their auditor can't be inspected by US regulators for a couple of years in a row, their stock could be delisted from the NASDAQ. While their current auditor is based in Singapore and registered with the PCAOB, there is still an underlying uncertainty related to China's cooperation with audits. This is a constant shadow hanging over us listed Chinese companies. The auditor's report itself is interesting. For 2025, their auditor is Accenture Pac, based in Singapore. But for 2024 and 2023, it was Audit Alliance LLP. They switched auditors recently, which can sometimes be a signal of something happening behind the scenes, though not always negative. So, to wrap it up, Infobird is facing a tough financial situation marked by massive operating losses and significant goodwill impairment in 2025. While they did bring in cash through financing, the core business is still burning cash, and they are heavily dependent on a few key customers. The regulatory environment, especially regarding audits and foreign investment in China, adds another layer of risk. The business strategy now heavily relies on the acquisitions made in 2024, especially Pure Tech, to turn things around. The risk I am watching is whether these new acquisitions can actually offset the massive operational losses and that customer concentration issue. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join our Discord.